Hello, Sage Seeds. We may be in the middle of a pattern that is repeating, helpful to us as long-term investors in companies like Mercury General Corp. And I'll put it simply, the younger you are, the more you pay for car insurance. Enough time has passed that the California exodus of 2020 is officially and significantly bleeding into the financial statements of car insurance companies in California. That's why we're going to connect the dots before Wall Street catches up. Let's dive in so that your wisdom can blossom.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
Beginning with a publication from the Stanford University Institute for Economic Policy Research. Love these guys. We're going to come to them for the best summarization of what this population drain is. California is losing population to Arizona and Texas at higher levels than ever before, including a greater share of college graduates and residents at all income levels. And there are our first clues: college graduates. Now, I'm not a specialist in the field of population statistics, but I imagine it's hard to be 16, 18, 20 years old, paying for car insurance, and also having already graduated college, meaning that this study has concluded that people in their late 20s or older are really the main people leaving California. California is still the largest state, constituting 11.7% of the US population. However, when we're talking about population growth, this chart shows in the blue line the annual percentage population change across a 60-year time period. For all insurance companies, the population change is the change in your customer pool. And since the year 2000 or so, Mercury General Corporation, as well as all other California insurance businesses, have been seeing this population growth stay well below 1%, which would be this horizontal line I'm hovering over right here. Interestingly enough, we can also see that 1989-1991 Great California Exodus, the first one, we can see how population growth dipped, but it actually never went to the negatives back then, versus the 2020 Great Exodus, where California actually did shrink during the years 2020, 2021, 2022. One of the major stories also found within this publication is that for the day-to-day decisions of most people, support for electric car subsidies is actually a big deal. California by far has the most generous electric car subsidies of the entire US and really the whole world, meaning that for young people deciding, I want an electric car, moving out of California literally means not being able to afford that electric car anymore. That matters when 61% of young people between the ages of 18 and 29 favor and or use electric car subsidies in this poll, while nearly half of people aged over 65 straight up oppose and wish these subsidies didn't exist. These 10-15 point swings at a population level make a massive difference if you're on the edge between moving or staying put. Now, all the surveys in this publication were restricted to residents of only 3 states: California and Arizona, Texas. Arizona and Texas chosen because these are the 2 states that have seen the most Californians move to them, but the sample sizes were all pretty well done, and we've got a kind of nice 3% margin of error. So this is a good high quality report about a migration trend that again has literally never happened before. Texas and California battle it out for most relocating residents. This article paints a slightly different picture of what's going on, claiming that in their surveys, the average California transplant to Texas was able to save more than $600,000 on their mortgage by moving and buying a home in places like Houston. The article then goes on to state that Texas has been a magnet for international home buyers for several years. While right now we're most focused on what makes a Californian leave California, the fact that they're choosing to move at scale to the third hottest US housing market is an additional hint that the majority of people exiting California are far along enough in life to purchase a home. That very likely is a big part of the decision for many of these statistics. When we look at this car insurance cost per age table, that puts you firmly at the bottom of the table instead of the top. The customers of Mercury General Corporation and all car insurance companies in California have become younger, less likely to have rich parents supporting reckless activity, and overall less likely to have the spending money to get into shenanigans. It's these twin engines that I think Wall Street and the market have not really understood quite yet. First, you have to realize that it's not random migration happening out of the state. Young people are staying in California California. That's pushing premiums up much, much higher. But the young people who get into the most accidents are usually living with their parents, going out every weekend, not necessarily having to sacrifice their weekends in order to work. Well, these young people are leaving the state along with their parents. So the young people that are left are not going out as much, are not getting into as many accidents, yet they still have to pay car insurance premiums based on historical averages. They get to charge prices that are quite profitable while also knowing that they can lower their prices to compete effectively and attract more business. On the thumbnail of this video, I am putting a picture of a young Warren Buffett because I'm going to compare it to his infamous Geico investment. Just like Geico in the 1950s, realizing that government employees were the absolute best demographic to focus on when selling life insurance, I believe Mercury General is realizing right now in real time that Californians are the best population to sell car insurance to. Diving into the annual report now, the management's letter quickly mentioning that 84% of automobile premiums are written in California. Drilling into the statement of cash flows, this blue row right here, from right to left, there's been a more than 10x increase in something called unearned premiums. And that's what I would like to focus on when understanding why this company is making so much money under the radar. First, we have to understand what is an unearned premium in the insurance industry. So turning to Investopedia for help, an unearned premium is the amount that corresponds to the time period remaining on an insurance policy. Unearned premiums are liabilities on Mercury General's balance sheet because they will be paid back upon cancellation of the policy. A helpful example is that if you have a 5-year car insurance policy with premiums of $2,000 per year, at the end of the first year, the insurer has premium of $2,000 and an unearned premium of $8,000. I will add that unearned premiums increase as your commitments from insurance customers increase. These unearned premiums are your visibility into future revenue. So going back to the actual numbers from Mercury General, a 10x increase in the amount of money that has been committed by customers is one of several positive trends. This is a company that, going back to MarketWatch, is currently making $467 million in the last year. More importantly, return on total capital is well above the averages you would expect in the current market climate, in the high 20s, and that's the torso on the 2 legs of compounding, which we can pick up from the valuation table. Total debt to enterprise value of only 14%, combined with, under the capitalization table, total debt to total capital quite high, $23 of debt for every $1 of total capital, yet the overall debt is really small relative to the enterprise value. Those 2 legs with the torso of more than decent return on total capital, and Mercury General is at the point of its business cycle when it's ready to compound. This is a dangerous competitor in its market because it's hit its economy of scale, and now it's just about flexing its pricing power or deciding to compete on cost if it sees an opportunity. Now, if anyone from California is watching this, I do apologize. I wish I could tell you that it looks like the major car insurance companies in your state want to compete on price. That would be great for the consumers, but nothing in this report really tells me that they're even focused on it. In fact, there's a lot of wording that is typically used when they want investors to think that price increases are necessary in the coming future. But for investors, neither option really matters that much. Flexing their pricing power accelerates the timeline of the value that we would expect to pull out of this business. And in the income statement, it looks like net premiums earned growing and growing and growing. MarketWatch is saying that sales growth in 2024 was over 18%. That is quite high for any finance company, but particularly fast for a kind of mature car insurance company specialist. So at the end of the day, Mercury General's profit is very, very likely to be increasing without much effort on their part for now. And similar to Geico in the 1950s, I would argue that selling electric vehicle car insurance to young people in California is probably the best version of a car insurance company that you could possibly create. And luckily, one of those does exist and is available on public markets. If you want to show your appreciation for this modern approach to value investing, please consider subscribing to the channel, leaving a like or a comment. Comments especially make me so happy because business is constantly evolving, and by the time you're watching this video, new things might have happened. Your perspective might be be a hidden gem that I would absolutely love you to share. Thanks for watching, and I'll see you in the next video. Bye, Sage Seeds.